Good afternoon. Robert Rayburn here from Life Pro Asset Management. I hope that everyone's having a great week so far. And I personally cannot believe it's the last week of August. It feels like it just began. But the good news is that the portfolios continue to progress. Despite the wall of worry that continues to be this immovable object on Wall Street, asset prices continue to advance. And this was a common theme that we saw in 2009, where everyone was fighting the recovery. And it was the number one investment mistake we saw both institutional and retail investors alike make during that time period. So the focus today is going to be about avoiding that mistake and how to properly position portfolios for success during the early stages of an economic recovery. Because even if you are long stocks, you can still make mistakes. So we'll go over all of that today. The other big thing that we're going to focus on is how important is the election. There's a lot of talk out there in the media around the presidential election and its potential impact on the stock market. We hear from clients every day as well as advisors, and the level of fear as it relates to the election, whether you're a Democrat or a Republican, is quite tangible. And so what we wanted to do today is take a look back in history, both during the divisive elections and more sort of plain vanilla elections, and see what were the actual impact on asset prices. Thirdly, we're going to go over the state of the stock market rally. Are we long in the tooth? Are we due for a pullback? Or are we in a period of sustained upside? So we're going to go and assess those different routes that are potentially at play here as we head into the volatile months of September and October. And then lastly, we're going to take a look at stock market valuations. Seen a lot of chatter out there about rising stock market multiples and how the multiple in the stock market is very similar to what we saw in 2000 and in 2007. So quite frankly, we're going to dispute a lot of those assertions, and we're going to walk through that evidence today. But in terms of the election, we want to sort of tackle this right away. Politics are a distraction. I know this is going to come to a shock to many people, both on the left and the right, as both have this vested interest in the outcome of November. And, if we think of investing, one of the biggest things we try to remove as successful investors is emotion. And there is no area that probably involves more emotion than politics. And so politics and emotion are positively correlated with each other, which means we need to do our best to remove our political hats when we're looking at the stock market, when we are assessing investments, and really take a step back and say, what's going to have the greater impact on asset prices? Some candidates' overall agenda, or the more likely event of what's likely to take place in the business cycle over the next 2 to 4 years and beyond. And as we can see here, we actually look back in history at the impact of whether we had a Republican president, a Republican sweep, or vice versa on the Democratic side. The reality is that the stock markets rise no matter what. Yes, we have down years, but those down years in the stock market are related to recessions. So in other words, the business cycle coming to an end, businesses got over exuberant, inventories got overloaded, and then we entered into an inventory correction. Or in 2008's case, we had the issue of the global financial crisis, which was really around lending habits of the banks. And so, in other words, yes, the elections are going to tie up a lot of intellectual capital here over the next 2 or 3 months, but from an investment perspective, they quite frankly don't really matter. Quick performance update here. As of August 26, we are up just under 60% net of fees. In other words, we are at an intra-year high. We talked last week and the week before how we are going through a period of consolidation, that strong businesses are like marathon runners. Sometimes you got to catch your breath, and sometimes you may even take a step back before advancing onto the next high. And that's exactly what happened. We had about a 2 to 3 week period of consolidation, And today, and quite frankly over the past week, we've seen the portfolios advance on and pass through that period of resistance and onto new highs as we see today. So overall in 2020, we're outperforming the stock market, in other words, the S&P 500, by just over 52.20% after fees. Since inception, which is January 1st, 2017, the portfolios are up 160.52% and have been able to outperform the S&P 500 by 105.14% after fees. So again, we say this every week. We're very happy with this performance, but overall, we have to make sure that going forward, our new investors and existing investors still have upside available to them. So what do? We assess each individual company at 5:30 a.m. every single day and we say, is the total return upside over the next 12 months greater than what we can get in a low-cost index S&P 500 product? If the answer is no, we rotate out of that stock and into a new stock, into a company that fits our traits and is positioned for significant upside. Now, in terms of fighting the tape and fighting the recovery, the chart on the left here says it all. We've had the fastest recovery after having a 30% sell-off in stock market history. And so people look at that recovery and say, well, that just means we are due for a fall. And the reality, of course, is that when we compare the recovery to the amount of cheap money that was injected into the system, and then combine that with corporate performance from the likes of Microsoft and Apple and Amazon, the fundamentals are marrying up with the rising supply of cheap money and low interest rates to really drive this recovery. The recovery makes sense when you look at the numbers. Corporate performance has been strong for the largest companies in the index. The cost of capital is at an all-time record low. And just as importantly, inflation is low, so we don't see that rise in interest rates anytime soon. So when we look at the amount of cheap money in the system versus 2008, it's not even a comparison, and the actual economy is beginning to recover. These are positive things if you are an investor in the stock market right now, and we are positively positioned as a result. Thirdly here, if we look at where we are in the recovery relative to 2009, we are almost tick for tick in line with how 2009 shaped out. And when we look at the supply of cheap money, when we look at corporate performance, and we look at the early indication that corporate earnings are now beginning to catch up to those rising stock market multiples, what we see here is the potential, based on our work, now we can be wrong, but the potential for a multi-year rally. We believe, based on our work, that we are in the first to second inning of this stock market recovery. So the biggest mistake we believe that we can make as portfolio managers or investors can make is to take that money, move out of the market, and play defense. Right now is a time of recovery, and we want to take advantage of that. We want to buy fantastic companies that are still available at discounted prices. The other thing we have heard a lot about is valuations. In other words, wow, PEs are, the stock market PEs at 24, 28, depending on how you look at it, reminds us a lot of 2000. Well, not so fast, because one of the things that happens after every recession is that stock market multiples expand. In fact, if we look at the market multiple from the trough in 2009, the exact same thing happened. In fact, those multiples rose even more than where we are at today. And why is that? Because earnings trough, that tends to be a trailing indicator. In other words, asset prices move in anticipation of an earnings recovery. In other words, the stock market's not looking at earnings this year. They don't care. 2020 is in the trash bin. They're looking at 2021 and, believe it or not, 2022. As businesses begin to normalize, what are these businesses that are positioned to dominate? And from that point of domination, what are those companies likely to earn in that type of environment? And that's how stock prices are ultimately being priced out right now. So the first thing that happens is the stock price itself moves up in anticipation of the recovery, and then a year to 2 years later, the earnings catch up to the stock price, and you actually get contracting multiples, but believe it or not, a rising stock price. So a stock market recovery happens in 2 stages. First, the markets price out a bottom and stock prices rise. The second wave of the recovery is when earnings catch up and start to power stock prices higher. We're still in the first stage of this recovery. The second stage likely happens next year and the year beyond. And we can see here the chart on the right, the number of days to recover the pre-recession levels of earnings per share. And you can see here 2008, 2009, it took almost 900 days. And as we know, by that point, we had a massive stock market rally that we would have missed out on over the 2 to 3 year time period. So we don't want to wait until earnings recover to actually be invested in the companies that we love. The other thing that we love about this stock market rally right now is the number of stocks that are participating in the rally continue to expand. So the red diamond here is the number of stocks that were in an uptrend based on each respective sector within the stock market 1 month ago. And then the top of the blue bar is how many stocks are in an uptrend today. In other words, what we see is, yes, technology and healthcare has been strong. We know that. That's one of our key overweights in the portfolio. But what's more interesting is look at the amount of sectors where the number of stocks in a positive uptrend, in other words, stocks are seeing rising prices relative to the overall market. What we see here is the number of stocks in a positive uptrend are rising amongst the industrials, which is a key economically sensitive sector, the communications sector, the materials sector, and this involves copper and chemicals, 2 key components when we think of any economic recovery. And then last but certainly not least, consumer discretionary, which we've seen one of the biggest upward adjustments in terms of the number of stocks in a positive uptrend. And that's super important. That's over 70% of U.S. economic output. So rising breadth equals a more sustainable long-term stock market rally. And then, of course, fund flows. I mean, this chart says it all. This is the cumulative level. This is the cumulative level of overall fund flows for bonds, in other words, fixed income versus equity. In other words, the crowd is piling into bonds, while the number of people invested in either precious metals or stocks is quite low. So when we see a chart like this, we don't want to go and buy what everyone else is buying. We want to invest in the assets that will benefit when these fund flows reverse. This is the investment way of saying we want to skate to where the puck is going, not to where it is today. And then, of course, the credit markets continue to heal. The level of credit risk within the high-yield bond market. So this is what we call high-yield credit CDX. In other words, the level of demand for bond insurance. In other words, this is insurance that pays off when high-yield bonds go default. And so during a recovery, the price for bond insurance goes down. And what we can see here is the price for bond insurance continues to decline, which is indicative of a healing credit market, and that the level of demand for bond insurance continues to decline, and that implies lower credit risk in the system. That is incredibly key in our overall homework when we look at sustainable stock market rallies. Lastly, the one thing we did want to talk about today was just because we're positive on the stock market does not mean that we want to go and invest in the assets that were at the center of the COVID storm. In other words, the cruise liners, the airliners, the hotels. Why is that? When we look at past crises, whether it was the 2000 technology bubble, to 2008 to 2009 global financial crisis, the stocks that are at the center of the storm tend to underperform the stock market for the next 6 to 8 years on average. And why is that? These businesses go into damage control. If we think of the cruise liners right now and the airliners, what are they doing? They're raising vast amounts of debt to survive, to merely survive, not go bankrupt. The problem is that debt becomes an overhang. Instead of recycling earnings into their businesses to try and grow their business, they have to take those retained earnings and they have to pay down debt. So you get these stagnant business models that are going through balance sheet repair, and balance sheet repair takes years, not months or days. And so for us, yes, a lot of these cruise liners, airliners, hotels are trading near 52-week lows, and they can seem like potential home runs, but we're focused on hitting singles or doubles. We're focused on companies that have already gone on offense and are positioned to dominate the recovery today and tomorrow. And that's what we're focused on right now. So overall, the long-term recovery is just getting started. Do not short this recovery. Ignore some of those emotional events such as the election. Politics and emotion are positively correlated, and emotion is bad for investment returns. So throw out politics when you're thinking about investing. Focus on companies that are positioned to dominate the recovery. Do not focus on center of the storm stocks. That is what you call swinging for a home run and then having a batting average of 100. We want to have a 300 to 400 batting average, be in the Hall of Fame, hitting those singles and doubles, and batting in our runners. And then lastly, investor flows continue to suggest that most investors are skeptical, and when most investors are skeptical, we are optimistic. That is what you want to see if you are invested in stocks right now. So overall, things look really good. If anyone has any questions, give us a call at 888-543-3776. Thank you for your business and have a fantastic week.